Well, hi, everybody, and welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
Just me. Hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Waren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rate. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. This week we're going over the building materials industry, and folks, this is a leading indicator of the economy because these are cyclical stocks, and you'll see why this is so in a few minutes. So the building materials industry, we're going over TREX, Martin Marietta, and Waren Material. All right, Debbie, let's go over our first stock, which is TREX.
All right, you're right. That is TREX, and it's the nation's largest manufacturer of non-wood decking alternative products. It produces wood polymer lumber, a wood plastic composite that provides the appearance and benefits of wood without the need for protective sealants or repairs.
Yay.
Yeah, easy. It markets the products under the TREX brand name, and it sells to approximately 3,000 independent contractor-oriented lumber yards through over 90 wholesale distribution locations across the country and has about 1,120 employees.
Okay, let's look at the numbers, and the first thing we want to look at is the clean surplus return on equity. And remember, to get into our growth portfolio, we look at a company that has a 20% or greater clean surplus return on equity. And as you can say, this stock certainly fills the bill. Now look down here in the beginning, back in years 2011, 2010, 2009, when there wasn't much growth in the economy, and you can see this stock kind of languished. But I want to show you 2007 all the way down here. It lost $1.28. 2011 slowed down in building, and it lost 7 cents. And now, all the way in 2019, projected to make $3.10. So the point I'm bringing out is that this stock, when the economy slows down, this stock really slows down and goes into negative territory. And that's how we tell if a company is a cyclical company or not, by looking at those years like 2007, 2008, 2009, and then 2011 also. But right now the economy's going good, and this stock is going gangbusters. It's not paying a dividend, which means it's taking all the money it's making and putting it back into itself in order to grow and gain market share. And years to pay debt, well, folks, it doesn't have any debt, so you can't get a better company than this, except it is a cyclical stock. And let's go to the past 12 months, and folks, you can see that this stock was doing great right up until about July. Now, as soon as a stock like this, or the building materials industry, hears the word recession or even smells the word recession, it starts to tank like a rocket. And you can see this stock. Now, you can't see the prices, but this stock went from $90 a share down to $55, which was a drop of 40%, while the market fell 20% in the fourth quarter of last year. So you can see that these kind of stocks, these cyclical stocks, make money when the economy's going good. They make great money, but boy, when the economy doesn't do good or when there is a smell of recession, these stocks start to drop much further and faster than the market itself. And looking at 5 years, we can see this stock has been doing good all the way up until this peak, which was around June or July, August for this particular stock. And then it fell that 40% that we're talking about. And now, of course, that the Fed has stopped raising interest rates, and it looks like the economy is going to grow, but slower, but continue to grow. The stock is doing very well. So, Debbie, let's go to the next stock and see how this stock has performed.
All righty. Up next is Marietta Materials Incorporated, and they're the nation's second largest producer of aggregates for the construction industry, including highway, infrastructure, commercial, and residential applications. The company also manufactures and markets other specialty products, including magnesia and structural composite products. The materials business, aggregates, cement, ready-mixed concrete, and asphalt, accounts for 93% of total revenues, and they have about 8,406 employees.
Now you can see that this is a little bit different than TREX because TREX has one product which replaces wood, which is a pretty good product, where Martin Marietta is in the aggregate business, and aggregate is, as this slide shows, cement, ready-mixed concrete, asphalt. It could be rocks, it could be gravel, it could be stone, and that's all termed aggregate. So looking at the clean surplus return on equity for this stock, we can see it's about half that of TREX. However, it's still above the average stock in the S&P 500, with the average stock with about a 13.5 clean surplus return on equity. And remember, the clean surplus return on equity is totally different than the accounting return on equity. So keep that in mind, folks. So the clean surplus return on equity is going up, and we go back to 2009, which we like to look at, and this stock had a net income of $1.91, down from $4 the previous year. So again, we're talking about a cyclical stock. Now, when we look at the dividend, it's paying a slight dividend of 1%, but years to pay debt. Folks, this stock has high debt, and Buffett's rule of thumb in years to pay debt, if a company can take all that it's earning and pay off its debt, how many years will it take to do that? And in this case, 5.2. But don't forget, this company is making a lot of money because the economy's going good right now. So if the economy slows down and that net income drops or the revenues drop, then the years to pay debt might go up, and that could put this company into a little bit of a problem. So we have to be careful with a company like this. Again, it's cyclical, and the clean surplus return on equity is below our threshold of 20%, but still above the average stock. So we would expect this stock to do better than the market averages. And when we look at the past 1 year, we can see that this stock has underperformed the S&P 500 because of the fourth quarter of 2018. And we can see where this stock began to top out. And folks, this is all the way back in June. So this stock just smelled the word recession, and all of a sudden the revenues started slowing down, and everybody who owned this stock began to sell it. So this stock was down drastically, but it's coming back. So we look at cyclical stocks, and do you want a cyclical stock in your portfolio? And then as we look at 5 years, we can see, yes, indeed, this stock is up about 65, well, almost 70%, while the market is up about 50-something percent. So as predicted by that clean surplus ROE, it is above the average, and this stock is outperforming the averages. But remember that word cyclical. Debbie, let's go into our last stock of the day.
All right, last up for this podcast is Vulcan Materials Company. They're a leading commercial producer and distributor of crushed stone. Produces aggregates at 375 aggregate production facilities, serving markets in 20 states across the United States, plus the District of Columbia, Mexico, and the Bahamas. They shipped 183.2 million tons of aggregates in 2017.
Sounds like a lot.
That's heavy stuff. They also operate 64 asphalt facilities as well as 57 concrete plants. They have about 7,900 employees.
Yeah, folks, I guess none of us realized what is behind the scenes and what kind of companies these are. I mean, 183 million tons of aggregate, 64 asphalt facilities. Yeah, that's the stuff they put on the roads, folks. 57 concrete plants. Wow. Let's look at that clean surplus ROE. And it's lower than the other two stocks that we looked at. We're going to compare them all in a second. And the clean surplus ROE has been rising over the years. But boy, when we look back at 2012, 2011, 2010, almost recessionary years, we see that this stock did not do very well at all. However, that ROE now is above the average stock in the S&P 500, and we would expect this stock to outperform the S&P 500 stocks. And years to pay debt, 4.3. It's still high for the stocks in our portfolio, folks. We don't care for that. So let's look at the past 1 year, and we can see this stock is underperforming the markets, and this is all because of that terrible fourth quarter with these cyclical stocks. It started back in June of last year that they started to decline because the market participants that are in these stocks know enough that when they hear that word recession, these stocks are out of the portfolio. And folks like us who don't watch it that much get caught in this kind of decline. So we have to be very, very careful of cyclicals. And you know that I personally do not like cyclicals. I can't stand a 40% drop when the market's dropping 20%. So yeah, folks, you can't sit through something like that and you wind up selling at the bottom. So I personally stay away from these type of stocks, cyclical stocks, I mean, but when the economy's going good, if you can catch that cycle, you're doing great. And looking over 5 years, yep, we can see that this stock is up about 60% while the market's up about 52, 53%. So as predicted by that clean surplus ROE, it is outperforming the market. And then let's look at these three stocks together. And over on the left, we see TREX with an ROE of 34%, Martin Marietta 16%, and Vulcan Materials 15%. So looking at this, and boy, folks, they expect the net income growth on TREX to be 40% next year on revenue growth of only 7.3%. How could that possibly be? Well, I'll tell you how. It's because they have a lot of fixed costs. And once they get past a certain threshold in sales, then most of the increased sales go to the bottom line. And that's how a company like this can have net income growing dramatically with a smaller amount of revenue growth. Again, cyclical stocks with big fixed costs, which we don't care for that much in our portfolios. But anyway, with TREX leading with the clean surplus ROE of 34%, and Martin Marietta half that, and Vulcan Materials even less than that, we would expect TREX to outperform Martin Marietta to outperform Vulcan, and all of these stocks to outperform the S&P 500. And looking at the three of them, yeah, there's TREX up about 300 and almost 40%, while the market is up about 52%. And let's take a closer look at Martin Marietta and Vulcan. And that's just these stocks without TREX in there. And we can see that Martin Marietta is outperforming Vulcan, and Vulcan is outperforming this black line, which is the S&P 500. And looking at all three once again, no question about it, TREX is the best out of these stocks. But again, TREX, along with these three stocks, is a cyclical stock. We don't like cyclical stocks in our portfolio, but those of you who are quick enough to pull the trigger when you hear that word recession, you can make a lot of money with these stocks, especially a company like TREX, which is just rocking and rolling out there, folks.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, don't forget, if you want to receive a full free month of all our letters and complete access to our computer program, just go to our site, buffettandbeyond.com, and sign up. Remember, all you need to manage your own portfolio, and it's free. Hey, just go to buffettandbeyond.com, and remember, Buffett is spelled with 2 F's and 2 T's. That's buffettandbeyond.com. Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Waren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.